Buying options to speculate on a stock move is a common option strategy that can offer attractive outcomes for shorter-term traders. In this video, we'll talk about owning options, long options, to explore the pros and cons and some ins and outs, and to provide a logical framework to implement a trade. Let's start with the question of why. Naturally, there are some pros and some cons. Why do investors buy options? Well, let's start with the pros. The most basic answer is for the leverage an option provides. For example, a long call can provide a multiple of the return a stock rally might produce. Call it more bang for your buck. The fact that a long option is a defined risk trade is also an important benefit. An option buyer pays to own the option, and that full amount is at risk. And because of the leverage, the trader can have much less capital on the line than an outright stock purchase would require. And importantly, the options buyer has a wide range of choice. Options markets offer leverage from high to low and time periods from hyper short to pretty long term. Those choices present varying probabilities to the trader. On the other side are the cons of the strategy, and that starts with time decay. Know that the premium you pay when you buy an option includes time value. And time value is also called extrinsic value, meaning it's the value of the option that isn't intrinsic. And that presents a problem for the trader because time only marches in one direction. And because the time to expiration will eventually be zero, the time value will eventually be zero, creating a headwind to overcome. The other risk factor you face is that your time is limited. The stock move you anticipate must play out within a specific time period. This is very different than stock ownership. The two risks above mean that an options buyer faces the possibility that the option will expire worthless. On top of those characteristics, there are some special considerations when it comes to put options. Both puts and calls offer leverage, defined risk, and choice. But with puts, you also have another dynamic. First, when stock prices fall, volatility tends to rise, and higher volatility tends to lead to higher option prices. This means that a put owner can gain even more sensitivity to a downward move if indeed volatility does rise. On the other side of the coin, there is of course time decay and a limited window, but two other aspects of down moves should be recognized. First, in long-term bull markets, downward moves are counter-trend, so it can be like swimming against the tide. It also means that because such moves are often short-lived, traders might be especially nimble when trading puts. So that summarizes the why. Now let's turn to the how. For an option buyer, the first step is to have an opinion on the underlying stock, because owning an option, call or put, is a directional strategy. Do you think the stock is going higher? Why? Your reasoning should guide your strategy. As an example, many option traders know that earnings season creates trading opportunity, and they're therefore attracted to trading options around earnings reports. Such an option buyer is motivated by an opinion on the company's fundamentals, its profitability, and seeks to base an option strategy on that point of view and timed to earnings release dates. If the stock reports earnings next month and you have an opinion about the results, you have a suitable setup for an option purchase. You have a known and specific time period and a directional opinion. It could be a call or a put, depending on your view. What if the stock reports earnings next week? Well, this is still a logical setup for an option purchase, with the important caveat that you are potentially in a very volatile period. Dramatic moves up and down can occur both leading up to the earnings announcement and in the aftermath. What about a long-term view of the growth prospects for the company? Well, that's probably a better reason to buy the stock outright or to consider very long-dated and expensive options. Another example would be a trader focused on a price chart. Suppose a trader observes that a stock reached what she thinks is an extreme low, then found support, and is bouncing higher. This is also a reasonable setup for a long call, but she should also consider that this may be a short-term counter-trend move, another important consideration when thinking about which option to trade. Stock charts are useful to the option trader in two ways: how they can inform the selection of a strike price and the expiration date. For example, a trader might use some basic technical chart analysis to determine reasonable price targets for the stock. In this chart, 3 previous high peaks may be logical. The first at $59, then $60, or perhaps the December high near $62. A chart can also help us in selecting an expiration date for our option. How long might it take for the stock to reach a selected price target? A look at this stock's history shows that it sometimes makes a fairly sharp up move. If that kind of a move occurs here, we might plan for a shorter time period to reach our target price. On the other hand, the stock might move at a more modest angle of ascent, telling us that we may need to hold the option's position longer. Let's turn our attention now to the task of selection, which option to trade. And for that, we start with time. How much time to expiration should we buy? Only then can we compare the various strike prices that are available. Why do we start with the expiration decision? Because time is of the essence. Let's examine the price of an option, the theoretical price of a call option on an imaginary stock. This chart shows the theoretical price at various time intervals as expiration approaches. Our imaginary stock is $50, and the strike price is $50. So this is an at-the-money call with no intrinsic value, and that means the option price is 100% time value. The first bar shows us that with 125 days to expiration, the theoretical price is $4.25 per share or $425. Compare that to the theoretical price of the option 10 days later, with 115 days left. Now the theoretical price is just $4.05, which is 4% lower. So in those 10 days, the theoretical value of the option is 4% lower because some of the time premium is now gone. This is the effect of time decay. Now see the decay in another 10-day period, this time from 95 days to 85. The option value loses 6%, and the effect only grows with time decay accelerating as the days dwindle. Notice how strong the impact of time is during those last few weeks. For this reason, some option traders plan to buy options with more time to expiration than the expected stock move so that they can close out the position well before expiration. This is an important strategic element for option buyers. Armed with this analysis, let's look at some prices in the options chain. So here's our options chain. Recall that our chart work pointed to two possible scenarios: a quick move that could happen in 20 days or so, or a longer-term move that might be twice as long. So we need to find expirations that fit our idea, two of which are selected here. The first one is very short-term, but it can fit our shorter scenario. If the stock makes the expected move in 20 days, we can sell the option at that point, and there will still be 31 days of time premium left. The next longer expiration is June, with 114 days to go. This is probably more time than we would really need, even for our longer scenario. So in our example, we'll go with the shorter term idea and focus on the April expiration with 51 days to go. In a basic option chain, calls are on the left and puts are on the right. So let's compare three call strike prices: one in the money, one at the money, and one out of the money. The first comparison we're going to make is for time value. Any option consists of two price components: the intrinsic value and the time value. But of course, not all options have intrinsic value, and at some point that time value will become zero. First, let's look at the 55 strike. This is an in-the-money call. In-the-money options have intrinsic value, and that's a simple number. For a call, intrinsic value is simply how far above the strike the stock is. So with the stock at 57.38, the 55 strike call has $2.38 of intrinsic value. And time value is just the rest of the price. What's left after we subtract the intrinsic value from the market price, or 72 cents per share in this case. The 57.50 call is at the money, or at least it's the closest to the stock price. But because the stock is lower, there is no intrinsic value, and therefore the option is entirely time premium. And same goes for the 60 strike. Bear in mind some essential truths about time value. First, time value is highest in at-the-money options. Second, out-of-the-money options are 100% time value. And third, time value will be zero at expiration. Now let's go back to the chain and compare the strikes in a different way. To do so, we'll introduce the idea of the delta. Delta represents the expected change in the price of an option if the price of the underlying stock moves $1. And by the way, delta is just one of the many data columns you can choose from for your own options chain layout in our Power E-Trade platform. Delta can help us see how much leverage we might get from a specific option if we compare the dollar delta to the dollar cost of the option. So first, here are the three options. with their per share premium expressed as the dollar cost. The next column converts the decimal delta values to dollars by multiplying by 100. Now, the ratio of the dollar delta to the dollar option cost reveals the difference in leverage between the three strikes. And what we see is that the out-of-the-money options give the trader higher leverage to the expected stock move. Out-of-the-money options produce high leverage, in-the-money options less so. But there's more to the story, because delta also highlights the other side of the coin, the risk, the probability of success in the trade. Delta can be interpreted as estimating the probability that the option will be in the money at expiration. But being in the money at expiration means only that the option will have some intrinsic value. An option might only be in the money by pennies. So this probability does not really express the likelihood of success. Rather, it makes more sense to recognize that if an option is not in the money, then it is out of the money, and therefore it has no intrinsic value, and therefore it expires worthless. So let's turn these probabilities around. If an option has a 74% chance of expiring in the money,